Hello and welcome. This is Business Incorporated on Channels Television. I'm Chimezi Ubi Iwago. On the show today, IMF says South Africa debt is becoming uncomfortable, but no bailout requested. Africa's largest fund manager sees next gold boom in West Africa. Plus, Ugandan central bank holds key lending rate at 10%. Let's get the show started now with the markets. And most major markets we track here in Africa were down at intraday today, with the Nigerian all-share index maintaining its downward trend, this time hitting the 26,000 levels. On Wednesday, the market recorded its largest single-day decline in 2019 since the 1.86% loss recorded on the 11th of July. Now, the South African market was also bleeding at intraday, down 1.30%. Stocks slipped to a near six-month low on Wednesday as both of the country's major stock indices weakened more than 2% following the inversion in the U.S. debt market. The Egyptian market is also feeling the heat, with the EGX 30 tumbling close to 2% at intraday. And then Kenya posted a marginal gain of 0.02% on Wednesday. In the Middle East, most major markets in the Gulf fell in early trade, extending their losses amid falling oil prices and fears of global recession triggered by disappointing economic data out of China and Europe. All right, looking at the Abu Dhabi index there, which eked out a marginal 0.02% gain at intraday. In Dubai, the index dropped over 1% as most of its real estate and banking shares traded lower. Dubai's largest listed developer, Emma Properties, fell 3%, while Emirates MBD shared 0.9%. And then in Qatar, the index was down 0.5%, decreasing further from previous session's closing when it hit its lowest loss in nearly a year. Look, the Saudi Arabian market is still closed for the Eid break and, of course, will resume on Sunday. In Europe, stocks gave up early gains to slip into negative territory in the morning today following a global sell-off as bond markets stoked fears of an impending recession. For more, here is Annette Wisbach. Hello, Annette. Good afternoon.
Good afternoon.
A sea of red there. What exactly happened to the markets?
Yeah, that's a good question. Actually, the market is very volatile today. You just see behind me that big billboard, which shows you that the DAX momentarily dropped into a very negative territory, now recovered slightly a little bit into the session. So what happened is that global recession fears hit big times yesterday during the afternoon with the US yield curve inverting, which is more or less a harbinger of a looming recession in the United States. And that has spooked investors worldwide because clearly if the states are falling into recession, one of the locomotives of world growth would kind of stop, because for now it looks that the United States are actually still one of the most healthy industrialized economies, spurring demand worldwide.
And can central banks help again, or are we talking about more of fiscal policy this time?
That's a good question. I mean, if you look around, central banks can't do an awful lot more. The Fed has some leeway on cutting rates, which they've already started. They have announced their cutting cycle, and the market is pricing in some more steps on the interest rates during the course of this year and next year for the United States. So they're clearly in easing mode. The ECB has its interest rates at 0, and we're waiting for a whole new package as soon as September to be announced, which would then also loosen its monetary policy stance. But what is very much clear is that the longer the ultra-loose monetary policy lasts, the less it is effective, meaning they can't do the trick once again, like in 2012, when the ECB stepped out and said whatever it takes to safeguard the euro and kind of turned around morale of the markets. This time it's an economic crisis, and there's not so much the ECB can really do or the Fed can really do. They can bolster the market, but they can't turn around the fortune of the real economy. When it comes to the fiscal policy, they could do a little bit more in order to boost demand for certain products by boosting their spending. But also here, there are not a lot of countries which have fiscal space. That's like the expression which economists are using for those countries who can actually afford to spend more money to increase their debt ratio and not spook the markets by doing so. The Germany is one example, but also the United States, according to the IMF, still have fiscal space. But also that measure is not enough to really change the trajectory of the economic outlook, because the economy is just going down because of a global weakness and because of all the tariffs and uncertainties installed by the US administration and China.
Well, and it is not just the equities and currencies that are taking the beating there. Now, oil is also below $60 a barrel. Now, it seems oil price faces severe headwinds as traders swing between demand-side worries and, of course, supply curtailment policies.
Yeah, it's a classical reaction of oil, because we have seen oil higher than $75 per barrel. We're talking Brent here. And with those recession or economic downturn risks materializing, getting more and more visible, oil also retracted, because clearly the rationale of oil traders is that if the economy is turning south, also less oil will be demanded. At the same time, we have increased stockpiles, and that is also adding pressure on oil. So in generally, oil currently is down by more than 2% when we are talking about Brent. And there's also no support on the horizon for the oil price, given the lackluster economic outlook.
Unfortunately, no one knows how long this will continue, but let's continue to keep our fingers crossed. Thank you for your time, Annette. Right, in London, shares were still sliding in the morning due to fears of an imminent recession, and as continued U.S.-China trade war worries weighed on heavyweight stocks. Well, let's see what the situation was like at intraday. Let's bring in Simon now from our London studio. Hello, Simon. Good afternoon.
Afternoon, Chimi. How are you?
I'm very well, thank you. How are the London equities and currencies markets holding up today after yesterday's nervous sessions across board?
Yeah, the FTSE 100 opened marginally lower this morning, but London shares have been sliding ever since the opening bell, all down across the board today. And as you said, it's due to what's thought to be that warning from China that it could take fresh countermeasures against US tariffs. And so the trade war goes on. There are also big warning signs for the UK economy after the government bond yield curve inverted this morning for the first time since 2008. An inversion is traditionally seen as a steadfast indicator of an upcoming recession, so a lot of worries there. And it all means that the FTSE has tumbled today. The all-share down 1.5%. The FTSE 100 is also way down at just over 1.59%, and the FTSE 250 down slightly less at 0.89%. The pound, as so often happens when the markets are tumbling, is in the green. The pound is up by 0.38%. It is 1.08 against the euro, and it is also up on the yen. So what often seems to happen is when the FTSE is struggling, the pound goes up. So the pound has been going down for months, but today a rare good day for the pound.
Well, the European Central Bank has asked UK banks to speed up on the movement of their staff to the EU ahead of Brexit deadline. What are the key concerns here for the ECB and, of course, the position of the banks?
Yeah, UK banks are significantly behind schedule in moving staff to the European Union ahead of Brexit and risk being caught off guard if Britain leaves without a deal. That is according to the European Central Bank. Many London-based banks are having to expand their EU operations to continue doing business in the bloc after Brexit, under plans agreed with the ECB. But the Eurozone's top banking watchdog has said so far banks have transferred significantly fewer activities critical functions and staff to euro area entities than originally forecast. The ECB now expects banks to speed up the implementation of their plans. So a warning there really to get moving, especially as every day that passes looks like we are edging closer to a no-deal exit from the EU.
Well, still on the messy Brexit, Jeremy Corbyn of the Labour Party is angling to push the new Prime Minister Boris Johnson out of 10 Downing Street. Why is Corbyn chasing Johnson, and are his proposals cutting eyes in the Brexit discuss?
Yeah, so following on from that last point that I was talking about, with Boris seemingly taking the UK to a no-deal exit scenario, Jeremy Corbyn, the leader of the opposition, has urged leaders of the other opposition parties and Tory rebels, people who don't like Boris Johnson and the Tory party, to install him as a caretaker prime minister in order to stop a no-deal Brexit. To do that, he would need to win a no-confidence vote in the government. His plan would be to then delay Brexit, call a snap election and campaign for another referendum. But it doesn't look like any of this is going to happen. The Liberal Democrat leader, Jo Swinson, said she would not support making Mr Corbyn prime minister, calling him divisive, and said he would not command MPs' support. She added that MPs should stand and be counted by trying to block a no-deal Brexit by passing legislation. Downing Street have responded to Mr Corbyn, saying that he would overrule the referendum and wreck the economy if he became prime minister. So I think Jeremy Corbyn is trying to stir things up in the House of Commons. He obviously wants an election. He wants the Labour Party to be in power and he wants to be prime minister. But at the moment, it doesn't look like this way is the way to do it.
Well, this is a story we'll continue to follow up, and I'm sure the markets will continue to keep an eye on that. Thank you, Simon.
Thanks, Jimmy.
And in Asia, shares were mixed today as the main yield curve in U.S. Treasuries inverted, triggering fears over the state of the U.S. economy. In mainland China, stocks rose on the day following an earlier slip. The Shanghai Composite gained 0.25%, while the Shenzhen Composite advanced 0.535%. Hong Kong's Hang Seng Index also rose 0.72%. Elsewhere, however, stocks largely saw losses. In Japan, the Nikkei 225 fell 1.21%. Australia's ASX 200 tumbled 2.85%. Markets in South Korea and India are closed on Thursday for holiday. And in the U.S. stock futures, he raised solid overnight gains early today after China vowed to take steps to counter U.S. tariffs, rattling global equity markets and sending Dow futures lower. At around 6:38 a.m. Eastern Time, Dow futures indicated a loss of more than 220 points after rallying more than 150 points earlier in the overnight session. S&P 500 futures were lower by 0.57%, while Nasdaq futures shed 1.2%. The massive sell-off on Wednesday was triggered by a bond market phenomenon where the yield on the benchmark 10-year Treasury note briefly broke below the 2-year rate. Our investors remained on edge about the trade tensions between the U.S. and China. President Donald Trump, in a tweet after the bell on Wednesday, linked the trade battle to the increasingly violent protests in Hong Kong, further complicating the trade issue. But he also proposed a personal meeting between him and Chinese President Xi Jinping. And away from the equities markets, they're looking at the commodities market. Oil prices steadied today following sharp overnight losses as U.S. crude inventories unexpectedly rose. Fears of recession mounted and economic data out of China and Europe disappointed. Brent crude was down 13 cents at $59.35 a barrel after falling 3% in the last session. U.S. crude was up 5 cents at $55.28 a barrel, having dropped 3.3% in the previous session. The combination of a slew of data suggesting a slowdown in the global growth amid the U.S.-China trade war and persistently high levels of oil in U.S. storage has punctured recent optimism in crude markets, but stoked expectations that leading producers may take further steps to support prices. And of course, in the metal market, gold prices edged lower today as investors locked in profits after the bullion gained nearly 1% in the previous session on safe haven buying amid concerns that a historic drop in long-term U.S. bond yields could portend a global recession. Our spot gold was down 0.2% at $1,512 per ounce. U.S. gold futures slipped 0.3% to $1,523. Fears of a global recession gripped gripped financial markets around the world as stocks slumped to more than 2 months low on Thursday, tracking a Wall Street slide. Among other precious metals, silver dipped 0.4% to $17.15 per ounce. Platinum gained 0.1% to $841.50 an ounce, and palladium climbed 0.6% to $1,432. Okay, we'll take a break now. When we come back, we'll bring you the domestic commodities market update as well as update on today's equities trading at Nigerian Stock Exchange. Do stay with us.